What's good? What's good? I'm back with a new show with a very respected guest, Charlie Lamdin. Many of you may know him as Moving Home with Charlie. Charlie started his career as a derivatives trader before moving into software development for the property industry, and that was at the end of the 1990s. So he's got extensive experience in the property market. Charlie is also a presenter of Moving Home with Charlie, which is a podcast, and he also has a YouTube channel, so I'll recommend to give him a follow. Charlie also founded bestagent.co.uk, which is a property site that is bringing transparency to the UK housing market. So I hope you enjoy the show.
How you doing, Char? How's life,
Good,
pal?
thanks, Mike. Not too bad, and you?
Yeah, all good. Can't complain. Can't complain. Glad it's February. A bit of a depressing month last month, really. New Year's been a lot
January
of
it goes a long time, doesn't it?
tax month. New Year. It's been a lot of geopolitical depressing events last month as well. So hopefully things get a bit more positive throughout the year. But I think we're going to have a bit of a depressing, negative year. We are, but hopefully we come out of it good at some point next year or whatever. How's business going, pal?
Yeah, actually, it's been really interesting. I mean, I agree with you. January was a bit of a bleak month. It was your birthday yesterday, wasn't it?
Yeah, yeah,
Nice way to celebrate the end of January.
cool. Thanks for the birthday message, by the way, pal.
Oh, you're welcome. You're welcome. Hope you had a good one. You're celebrating tomorrow, right? For the weekend. Is that right?
Yeah, yeah,
So well, I mean, it's the same for me as the property market, really. So the property market
yeah,
has definitely seen more buyer interest in January 24 than it did in January 23. January 23 was very, very low interest. There's a bit of a sigh of relief amongst some of the agents that I'm talking to that there is a bit of activity. And I think that there are some savvy buyers out there who are starting to pick the low-hanging fruit of some of the lower price properties where sellers are going, you know what, let's just get this sold because 2024 is looking a
yeah.
bit weak.
I know a couple of people capitalizing on the lack of confidence that look, obviously hit the property market last year and rates rising, and a couple of them got good deals. So would you say that the main driver behind the uptick in January is people trying to find value in the property market? Would you say that's the main driver, value
Uh,
investing?
I actually think the main driver is the price reductions that are happening, and you saw it in Rightmove's December and Rightmove's January.
Yeah,
There's a slight uptick on asking prices, the big drop in December, and I think I think the price houses above 600,000 on Rightmove dropped over 5% in 1 month. The average asking price of new stock coming to the
oh,
market.
yeah, it was a big hit, weren't it?
And so I genuinely think there are buyers going, okay, there are some asking prices now starting to come down into the realms of reality. And there are people who need to buy. There are always people, and so there's a
Yeah,
little bit of pent up demand from people who needed to buy. And as more and more sellers are getting more realistic, which the estate agency industry and the estate agency, Rightmove itself in every single monthly report is saying sellers need to be more realistic. Sellers need to be more realistic. Which what they mean by that is sellers need to drop their prices. And the sellers who are
yeah,
coming to the market, especially the sellers who are upsizing, and they're realizing, let's just sell for whatever we need to sell for, so that we can then move up. Because if you're upsizing, it's a sweet time to upsize because the price drops are bigger at the
yeah,
higher end. So those people who are fortunate enough to be in a position to upsize are actually having a good time of it right now.
yeah. And those who are obviously investing, they're seeking value through prices reducing. Kind of like the stock market, there's a lot of value that's being captured at the moment because a lot of stock prices have fallen quite a lot. So you do have a rush of new money coming in when there is a reduction in prices. So obviously that's started to occur now, but it does take a long while for the large wave of new money coming in, which does revert. Well, basically, it does sort of make prices go back up because when there's a lot of sellers, but when there is a new wave of buyers that are seeking value, those value investors don't really tend to push up the prices. They don't. It's the main wave of buyers, whether it's first-time buyers, investors, or funds, you name it, whereas a lot of people aren't really liquid at the moment. A lot of investors aren't really liquid at the moment. So those who are biting and buying are obviously those who have been a bit liquid, whereas a lot of investors in the property market, they're a bit illiquid at the moment. Like you mentioned about Rightmove, that is basically well, they're being honest to people. Since interest rates started to rise, their stock has fallen 26%, I think. So they've lost a quarter of the value of their stock price since rates started to rise. And not
Yeah.
rise, and obviously their business is driven by the volume of properties that get sold.
No, not quite. So most of Rightmove's income is subscription income. So it's fixed income from estate agency subscriptions. But the problem is, and I think the reason why the Rightmove share price has dropped is that it's become clear that a lot of estate agents are going out of business.
You think so?
Yeah. Oh, I know so. I mean, I know that there were 5,000 estate agency businesses closed last year, 3,000 new startups. So there was a net reduction of just under 2,000 estate agents last year. But
do you reckon that's driving traders and investors to offload Rightmove stock, though? Do you think they're offloading Rightmove stock because of that? Yes, but also the property market as a whole, because 9 out of 10 property stocks are down in value since rates started to rise.
Yeah.
So I think it's a mixture of what you're saying, a reduction in the income due to the subscription, but I think the market as a whole, investors and traders, I think they're just pricing the property market, or they're just pricing in across all of property stocks. And property stocks, well, 9 out of 10 of them, they have fallen between 20 and 30% across the board. So we are seeing a bit of a correlation there. So Rightmove stock is fallen, correlated with house builders and other types of property stock. But their income has been rising. It has. So their income has been rising and their profits have been rising as well. But they're being honest in terms of the market itself.
I wouldn't classify Rightmove as a property stock. It's a media and a software stock. You know, it doesn't actually derive any of its income out of property transactions whatsoever. It's all advertising income from subscriptions, and then also they get some advertising sales from ads on their site, and mortgage referrals as well, which is slightly transaction based. But it is a subscription income advertising business.
Yeah, it's still got full exposure to the property market. It's the exposure to the market itself that's the key when traders and investors look at the stocks, if you know what I mean.
Yeah. Well, because Rightmove's income is almost all from estate agents. Those traders are quite rightly looking at the estate agents businesses and going, well, they're all having a really rough time of it. I spoke to estate agents just yesterday saying 2023 was the worst year either they've had on record that they can remember since 2008, 2009. It's a really bad year, and there is January has definitely seen an improvement in activity, and that is welcome for everybody, whoever you are, whether you're an investor, whether you're a mover. That's a good thing, but we're only talking about an uptick from an already very low base. We're still way below normal transaction volumes, so any increase is welcome. But I think there's a lot of over optimism based on the smallest improvement. And they're like, it's activity's come back. Everything's it's a small increase from a very low base, but a welcome increase nevertheless.
It's what I call the crypto touch. Whenever there's something positive that occurs in the crypto market, it's like they all congratulate. It's like, right, this is the future. The whole game is changing now, and whether it's just a little policy or something little that gets enacted by a regulator, like the Bitcoin ETF when that went public, those who have been pushing and those who have been pro Bitcoin and cryptocurrency going back all these years, they're treating it as victory. They're treating it as we was right. Look, the Bitcoin ETF is one of the reasons why we've been right. So there's a bit of a crypto touch when it comes to estate agents and positive announcements or news related to the property market. What's your opinion throughout 2024 on the market? What do you think the market as a whole, property prices, how do you think they're gonna perform throughout this year?
I'm probably the most bearish person on house prices that you're going to meet. And I have even close associates of mine saying, Charlie, we don't agree with you. We don't agree with you. We don't think
I
so.
can imagine, mate. Yeah.
You know, the close associates, people who support me on almost everything else, just go, we don't agree with your 35% overall average. Now, first of all, it's so important to remember that there are the property market is not something that you can look at a macro level, because no two different areas of the market perform the same. Yes, you can pull an overall average, but for example, the most recent land registry stock index showed Northern Ireland and Scotland going up and England and Wales going down. So when you've got an average of that, which is, well, basically it's in the middle and it's flat, that doesn't mean the housing market's flat. It means we've got two going up and two going down. You know, so England and Wales and actually London faring the worst of all of them.
They're looking at the macro picture, not the micro pictures.
Yes, exactly. So, your question, like, what do I see the housing market doing? So, in terms of housing market health, the health of the market is all about transaction volumes. And I mean, hope is not a strategy, but I don't have a strong opinion on what's going to happen to transaction volumes. I hope transaction volumes improve for everyone that needs them to improve, and it helps everyone. It helps the movers. It helps society. It helps businesses that are in the moving industry. It helps home movers, whether you're buying or selling. It's good to have transactions in the volume. When it comes to prices, the reason that I am so bearish, and even in the face of close associates saying, Charlie, how can you be this bearish? I don't want to be this bearish, because it's extremely bad news for a lot of people. There are people waiting to buy who are saying it's good news that it's coming down, and I get that too. But actually, unfortunately, I don't even see that as being good news, because the reason it's going to go down so badly is because of what I see happening to employment and wages.
Yes.
If employment and wages get hit like I think that they are being and are going to be hit, then those people aren't going to be in a position to buy anyway, even when prices are. So this is why it's actually, should you buy now or wait? Well, it depends. It depends what your reasons are. You know, there are some people I'd say, look, even though prices are going to fall, if you can get a mortgage now, but your job is looking a bit iffy, I would jump at it. Get the mortgage, get the home, and find a way through, because it's better to be in a home and then lose your job than lose your job and therefore not be able to get a home, if you know what I mean. You know, so a lot of people, even if they've bought their homes, but then they lose their job, they'll find a way through, if you know what I mean. At least they got their home. And I get these stories all the time from people this happened to in 2008. You know, they say, we just bought our home in 2006, 2007. We lost our job in 2008. We were in negative equity. We had, we were struggling, but we managed, we made it through, and we held on to our home. And it took 10 years before we were back in positive equity, but we're still glad we had a home all that time, because having a home is the most important thing for everybody. But when it comes to, from an investor standpoint, I mean, there are different ways to get into the market from an investor's point of view, but I think landlords, being a landlord is not an investment, it's a business. Right? You are choosing to go into the business of being a landlord, and that business has overheads, it has risks, it has all kinds of maintenance, and so it's not an investment.
It has a risk to reward level to it. Just like any other asset or market.
Everyone needs to understand this, and a lot of people have lost sight of the fact that being a landlord isn't an investment; it is a business. And so you're investing in the business of being a landlord. You've then got to see how good or bad you are at being a landlord, and how well you manage your risk, how well you manage your margins, and that kind of stuff. And of course, there's a lot of retail landlords who are being absolutely wiped out now, because they got in when it was easy and it looked easy, and thought, oh yeah, we're all going to be millionaires, from nothing. That's just because the conditions of the market, very high rents, very low interest rates. Any numpty could do that, and that's, don't mean that as an insult. I mean, you didn't need to have any skill whatsoever, or any knowledge, or any investment skills to do that.
No,
but that
is riding a bubble.
Changed. If you are a business-minded investor and you think that I'm going to go into this as a hands-on business, then there are definitely opportunities. If you've got cash to invest, I wouldn't go near buy-to-let mortgage in this market. Wouldn't go near it. But if you've got actual cash and you're looking for a business to run, then there are opportunities to buy flats out there at sensible prices. You won't need to absolutely screw your tenants on rent to meet your higher mortgage interest rates. You'll be able to charge a fair rent, which means that you'll get a fair return for a long time because you won't keep having them turning over. And then you manage your assets. You've got to nurture those assets and maintain your asset. And your assets are twofold. Your assets are the property itself, and the tenant is also an asset.
Yeah.
And you've got to see those two things differently, right? The property itself is an asset, but without a tenant, it's a liability. So your tenant and your relationship with the tenant is an asset too. And the intelligent landlords I see that do that properly they take a really long-term view. They look to have tenants moving in to stay for the long term. They don't try and squeeze every last penny out of the yield because they realize that's short-termist.
Yeah.
They end up with long-term tenants that are happy and stay paying their rent, don't keep moving out. So from that point of view, if there are people with cash considering being a landlord without borrowings, there are opportunities right now, opportunities to do that. But if you're looking to actually sort of trade the housing market, I don't think there's a way of shorting it, is there? If there was, I'd be shorting it.
Well, shorted through the property stocks.
Well, yeah, you can do it that way.
But that's too late now. I'll explain in a bit about the property stocks, but they've already been hammered. Billions have been wiped off.
Foxtons Foxtons' biggest shareholders are saying we should be selling now. They want to get out, but the guy running Foxtons whose name is actually Guy.
Foxtons stock got so hammered before rates started rising, hammered so much. It's still in a negative territory. Since rates started to rise, Foxtons stock is up 35%. It got hammered so much before the interest rates started to rise. So that's been one of the 10 stocks. But if you look back 5 years and before rates started to rise, and you just think, well, Foxtons has just been hammered a lot. But to be fair, I think Foxtons is quite a valuable business because, I mean, there is risk to it, but I think there is a hell of a lot of reward, which is why a lot of these companies, stocks, when they fall in price, it attracts a lot of takeover bids. These companies attract a lot of takeover bids, and that's why a lot of companies in the city are in defence mode at the moment, because a lot of liquidity has been taken out of the UK stock market, resulting in a lot of UK stocks being undervalued, and there's been a form of de-equitisation where some stocks are leaving London stock market and going to America because the liquidity in the London stock market is falling a lot. So that's another obviously factor. But in order to stop the short property market, the easy way is through shorting stocks, but there are other ways through shorting bonds and stuff like that. But that's more on an institutional fund level. But in terms of the micro side of it, I was going to say, I'm seeing micro property bubbles that are bursting. You've got luxury property in London, a lot of luxury property are taking a hit in prices, 500,000 plus property in areas like Kent, coastal regions that have been subject to a bubble throughout the 2010s.
Yeah.
Mantopia, aka Manchester, prices around there, certain prices around there are taking a fall. So on a micro level, what region do you think is going to get hurt the most in terms of property prices? City or county?
Well,
a lot of people say London.
Yeah. I mean, that is.
I think you might have a different, I don't know, opinion.
I was just trying to not jump to that conclusion because that is what I want to say, is that London. And by the way, that hurts me if I'm right about that, because my flat's in London.
I think Kent, Surrey, Sussex, a lot of them areas are going to get hit because a lot of them areas have been subject to a property bubble. The Surrey stockbroker bill, a lot of people left London in the past 15 years to move out to areas like Kent, Essex. the property prices in Essex went up exponentially. And because the country and because the government is kind of needs to build and the demand to build more houses is growing, this areas like Sussex, Surrey, Kent, Essex, they can take on that demand because they've got a lot of space.
Yeah.
So my theory is it's going to be the region, the counties, which are full of people which are mainly residing in the middle and the upper class. They're going to get hurt a lot more than areas, I say, like Scotland, maybe certain places in East England, North England. Do you reckon my theories? What do you reckon my theories?
I think so. I think you're right. I think that but again, you got the region, right? You got the counties or the cities. I think I worry about Bristol as well. Bristol has held on to high prices a lot longer than anywhere else, a lot longer. And I think there's been a bit of an exodus from London in the last year or so, and there'll be people moving from London to Bristol and from London to Manchester, from London to Liverpool. And that's, I think, one of the reasons why London's prices have, even with a late land registry, is showing London's prices faring the worst.
Yeah.
I think because you've listened to me and Alex Groundwater talking about the economy and banks. I agree with Alex about where the overall economy is headed, and therefore I think London may be facing not a bang, not a crash, but a really, really poor, like just sliding down backwards performance. And because of the cost of living, and ordinary people can't bring a family up in London anymore. Just forget it. You want to have a place to bring up kids in London. You've got to be a millionaire, literally.
Yeah.
So people, especially people who do have the ability to work from home, which is perhaps it's fewer people now than it was, but it's still plenty that can do that. They are moving out. They're moving further afield. They're looking around. Compared to even compared to 10 years ago, the flexibility of where you can base yourself for work now is much greater than it was. The requirements for commuting, easy commuting, are much lower requirements than they were. So I'm going to say London is going to fare one of the worst. I think Scotland's cities are going to. I think Edinburgh is going to have a bit of a problem.
Yeah.
But I do think it's going to be much more at the higher end. I think the demand for cheaper, smaller, lower priced homes is going to hold up quite well.
Yeah.
And while there will be price falls even down there, because the demand there relies heavily on mortgage finance, and mortgage finance is going to be becoming harder to come by as jobs and incomes fall. But I don't think the falls will be as bad at the lower end as they will at the higher end.
Yeah. Do you think the higher end is going to drag down the national price level? So the prices across the country, do you reckon high end?
Well, the problem is
high prices houses going to drag it down?
That's what's been skewing the average and making the average transaction value actually increase. A greater volume of sales at the higher price.
I got ya. Yeah.
Is causing the average to appear to hold up or to go higher, when actually what's happening is there are much fewer than usual transactions at the lower end. And I know that like the house price indices they call it the average, but it's not. It's a hedonically regressed, seasonally adjusted, all kinds of other weighted. It isn't any form of average. It's an index. It's a weirdly calculated index that they call an average, and it isn't an average. Not by any measure is it an average.
Yeah.
But it's but it is a transaction value that they try to calculate. That's hugely misleading. So I think the above 500,000 has already seen much worse falls than below. But I do think the worst generally speaking, notwithstanding regional variations and local variations, I think 2024, once we see the reports of it finally coming out, are going to see much worse price falls in 2023.
Yeah, because the media ain't going to be able to somehow sort of create a positive perception of something that's currently negative.
Yeah, you can. What are there any restrictions on our language in this podcast, Mike, or not really?
No,
because I was just you can only airbrush an asshole so much, can't you?
Exactly. And it's been quite funny looking at some of these articles it has. But there has, I mean, maybe that has contributed towards prices not as falling as much as what's many contrarians or realists assume they would have fall before price interest rates started to rise all the way up to 5.25%. What about land prices, Char? Because I've not really
Um,
been looking at land prices. How are they faring?
well, I saw a really interesting Knight Frank put out a study just the other day before about land prices, and green land prices are lower than they were in 2011. Um,
Why, may
I,
I ask?
I don't know. I was surprised to see that. I was very surprised. So I mean, maybe they've overbought. Maybe
Yeah,
they've overbought, and I think perhaps now suddenly the demand for green land has reduced because the builders, as you know, the construction field is really struggling because of its costs at the moment, and they're mothballing. Many sites are getting mothballed. So the demand for land, which means there might, for those people who want to look to buy land and build themselves, I reckon the next few years that might start to look more attractive than it has done for the last few years.
yeah. One of my clients has been keeping their eye on land a lot, and they want to do get into it over the next couple of years. They
And Mike,
do.
just going back to that previous point, there is no evidence of this. I know that there's no data to back this up. There are only suggestions and points and circumstantial stuff. But you put it all together, and in my mind, there's a very high level of certainty that actual house prices themselves have fallen already and did last year fall significantly further than the indexes are
Yeah,
saying.
yeah. And I think that housing stocks and property stocks and house building stocks sort of show that that's a reality. Show that what you're saying is a reality because across the board they're down between 20 and 30%. They
Yeah.
are, and that's 9 out of 10 UK property stocks. Barrett's down 25%. This is since interest rates first started to rise. So this is what the market investors and traders have priced in across the UK property market stocks. Rightmove down 25%. Persimmon down 42%. Taylor Wimpey down 11%. Crest Nicholson down 38%. Land Securities Group 14%. Bellway 13%. Segro 34%. Redrow 12%, Vistry 10%, Watkin Jones has been hammered 80%, that's down, British Land 28%, Granger 15%, Savills 28%. Only two main ones that are up, well, haven't been, the price haven't fallen since rates rise. There's been Foxtons, that's up 35%, but that's because it got hammered so much. So value traders have been buying a bit of Foxton stock at low value because the risk is quite
Well, I
minimal
mean,
compared to the reward. And Berkeley is flat. But 9 out of 10 property stocks, if you look at the property
yeah.
market through the lens of property stocks and house builders, it's in a bear market.
It's funny you say that. I mean, Foxtons, I think, is different because they had that change of CEO about a year ago, and he's definitely
Yes.
improved their performance, just their operational performance, so that's why I think, I would have bought when he started. I would have bought.
Yeah.
Okay, but all those other stocks you talk about, I mean, that is really interesting because you're saying that is a reflection. You look at that basket of property stocks and they're down. That's a reflection of the housing market.
Yeah.
I don't know if I do these one-to-one video calls with people who want to book time with me to talk about it. And I had one chap who said he'd been trying to buy a new build from this developer, which no one else was offering on it. It was a flat. It was down in the southeast of England. And he put in an offer about 20% below asking a year ago because he genuinely thought that was fair. And they said no. He went back 3 months later. They hadn't sold it, and he offered the same. They went no, no, no. Eventually,
They took it.
eventually in December, yeah, they came down and they hit his bid a year after he wanted to buy it anyway. By which time, that literally the day he'd found another place for this exactly the same money, 50% bigger, nicer property for the same money. And so by the time they accepted it, it's like, no, sorry, it's fallen away now. That's it. And I think to myself, when you are in the business of building and selling stuff, and you don't see the writing on the wall when you're actually in the market like that, and you've got offers out there and you just don't take them. I mean, and now they haven't sold that place. And if
Yeah.
they
And
take
then
those offers
they
6 months ago,
finally capitulate.
They do, and they've done it, and they've left it too late, and now he's gone, and now it's unsold again.
Typical bubble behaviour, though, Char.
Yeah, but this is
Denial,
my point. You hear stories like this
capitulation.
left, right, and centre all over the place, and people go, "Oh, house prices haven't come down that much." I'm sorry,
Yes, they have.
I can't explain how the indexes calculate what they calculate, but it's not. They are not painting a true picture. And of course, because Halifax and Nationwide lend everywhere in the UK, there are Scotland's going up and Northern Ireland's going up. So that's going to
Yeah,
distort the picture of what's happening in England and Wales. You
yeah,
know, I'm doing this exchange price index, right?
yeah.
Had you noticed that? I'm launching this, so it's allowing movers themselves, because they've got this in Ireland. In Ireland, there's a property price report that comes out every week with the property prices that were exchanged the previous week. So in other words, there's
It's
public
sort of
prices.
real time.
Yeah, it's almost real time, which just makes sense. So I'm launching the Best Agent open source house price index, where anyone involved with the transaction, buyer, seller, agent, conveyancer, and even landlords and tenants can report their house prices for sales and lettings.
Investment funds will jump onto that. City funds will jump onto that, and traders, they will, because they'll use that to gauge,
Yeah,
to measure potential, well, what's happening in the property market in terms of stocks and
yeah,
securities and stuff like that. Good
yeah.
idea. I like it, Char. Send it my way, and I let all my clients and my followers know when it's up
Well,
and
Brett, thank
running.
you. I will take you up on that, because it's going to depend entirely on the viral effect of social networks, because I've already had we've already been hacked. The people who don't want it to happen. There's people who want to
I
stop it.
bet it's not.
Yeah, which I'm trying to bring transparency to the market, and there are people there who just don't want that. They don't want transparency.
But to be fair, though, if from an investor's and a commercial point of view, that's not completely invested in the property market, even those invested in the property market will probably end up, even those who might be the critical ones over it, will probably end up consuming it, Jar. So sometimes the critics can tend to be the good consumers, but
Yeah,
they tried to hack. Yeah, that is a bit harsh. So, but when you are entering something that's quite traditional and you're disrupting things, you do attract a lot of I don't know, bad agents, as I must say.
yeah, yeah. I'm getting some real pushback, and even
Have
people who are associated with me they're getting grief. They're getting stick for it
oh,
behind the scenes.
send
So
me over if you are going to do a little advert on Yildo, send it over to me. I'll whack a few of them on my show for you, mate.
thank you.
I'll help
Very much
you
appreciate
get it
that.
out there.
Very much appreciate
I'd
that.
like to
Yeah.
know your view on the money supply. Its connection to the property market. Now, the UK M2 money supply is correlated with house prices. Within 3 months of quantitative tightening, house prices started to fall. So the money supply is driving the house prices. Quantitative easing, house prices up. Quantitative tightening, house prices down. In your opinion, why doesn't the media and many entities within the property market talk more about this? Because they seem to put it on the housing supply is one of the main contributors to the supply of housing, and interest rates is one of the main contributors towards house pricing. But money supply is showing, if you basically connect the M2 money supply with the house prices going back 20, 30, 40 years, there's a big correlation. Why don't you think the industry itself or the mainstream media focus more on that? Because that's basically stating, look, the money supply is why housing entered the bubble and it's become unaffordable. Why don't you think that is, in
So
your opinion?
the property industry don't focus on that, because they are all, I mean, the majority of them, except for the really intelligent ones, the majority of them are just so hardwired that you got to talk the market up non-stop. Therefore, you will highlight anything that's positive news about it. But if there's anything negative that might suggest how prices are coming down, you just don't talk about it. You just don't talk about it. You
Yeah,
don't talk about it. And that is, I mean, that is hardwired into people on their first day in a estate agency. When's a good time to
yeah,
buy? Now. When's a good time to sell? Now. What house price is doing? Going up. That's it.
yeah.
You have those three things drilled into you on day one. That's all you ever say. And literally, it's virtually beaten into them. Always going up, because in the long term, that's true.
Yeah.
And so why doesn't the property industry talk about it? Because the property industry will never talk about anything that might make house prices go down. They just won't. They just,
Yeah.
even though actually it would help them with transaction volume. So the problem is that house sellers don't want to hear it either. So
Yeah.
they don't want to hear their estate agent talking the market down.
Another thing to factor in as well, I think I mentioned this to Alex as well, is that the mainstream media, they're, well, I don't know what proportion, but a lot of well, a chunk of their clients are property companies. They are all mortgage companies, or banks which are exposed to the mortgage market. So when you look at it from that point of view, mainstream media companies and tabloids that are honest about the property market would be directly putting off their clients who are exposed to the property market, because if you've got one page which is saying, look, this is the reality of the property market, here's data, here's this, here's that, here's a contrarian opinion, and then on the next page you've got an advert with a mortgage company, or you've got an advert with a house building company, that house building company or that mortgage company is not going to be inclined to advertise in a tabloid or in on a TV channel if that TV channel or that tabloid is being critical to the property market. So that's another factor which I believe it is why the confidence in the property market is not as low as what it should be. It's not as low as what realists like yourself and others, people like me, and even people I know who own property, a lot of them are in the realist realm where they're saying like, look, we kind of need a reduction. We need reality and we need rationality to come as soon as possible. And the quicker the reduction, the quicker we'll have a recovery. So the quicker it's quicker reduction, the quicker the recovery. But in order to have the quick reduction, there needs to be a major wave of reality hitting the media, the market, and the financial services sector as a whole.
Yeah.
Do you think they could backstop the downturn in the property prices if they got a bit out of hand this year through reversing quantitative tightening and embarking back upon the path of quantitative easing? Because the people I speak to from the financial market and the capital market, in the land of financial and capital markets, they believe that the main thing that could stop house prices from falling and could create a recovery would be quantitative easing, but it would require a big event for banks to embark upon quantitative easing again.
Well,
What do you think?
anyone who thinks that has got extremely short memory, because all you've got to do is go and look back at 2008 and look at house prices to see that despite quantitative easing, there was no significant increase in house prices for 5 years.
Yeah, the difference now though is that throughout 2008, bank deposits were collapsed, and then quantitative easing supplementing those bank deposits and obviously increase them in the long term. Now bank deposits are still quite high because of the major wave of quantitative easing in 2020. So I think that is one fact, because I have thought of that myself and others have thought of that, and that's the difference when you look at the money supply throughout 2008 and 2010. It did fall, and then the quantitative easing supplemented that fall. Whereas if quantitative easing were to occur, let's say in 6 months, that's only supplementing a reduction in the money supply going back 18 months. So is because I don't know, because put it this way, Charles, if they come out and said we are embarking back upon quantitative easing, there'd be a wave of capital flying into property stocks. Straight away, that would be bullish for the property market. It would be bullish for the whole stock market. So I'm thinking, could property be part of that, or are we past that point? Or are we past that point where we're on a downward trajectory, just a case of how low are they going to go on a micro level as well as on a national level?
Well, I think you're right that there would need to be a major event for that to happen, because the Bank of England has declared its intention to pursue its QT, for as long as necessary to reverse the effects of QE. That's its declared stated policy. So there would need to be something major to happen.
Yeah.
If something major did happen, you've got to think, well, even if there's QE again, until employment is strong, banks still aren't going to lend money to people who haven't got jobs.
Exactly.
So you'd if you had the combination of QE, rising employment, and rising real wages, then yes, absolutely, you'd see house prices start to go back up in real terms.
Yeah.
But I think it would take all three of those things. I don't think 2 out of 3, it might level it off, but it wouldn't put it back up. You must. Alex has done the graphs on this. You must have sustained real wage growth, and I don't just mean the official figures. I think what's happened recently. The most recent official real wage growth figure is 1.4%, but that doesn't take into account tax rises and the real cost of living measurement either. So people are still actually their net real worse off despite that 1% real growth, which is why I think we're going to see more house price falls this year. So I mean, I honestly, barring some extraordinary, I mean, do you know what? I mean, the idea I keep on putting out there, which is what I would do if I was the government, because I think it solves many problems, including one of the government's own problems, is that I would embark on a carefully selected, in terms of regions, but very aggressive social house building program where the government builds it, right? So the government hires the building for, so it basically competes with the private sector, and the government says, okay, private sector, you carry on doing what you're doing, you build as much as you want, whatever, we'll make it easy for you, we'll reduce planning restrictions and make it easy for you to build houses. We're also going to build houses. We're going to build them. We're going to keep them. We're going to create employment by doing that. It's going to boost the economy. The government's then going to own these properties and have them on the government's own balance sheet, and the government's going to get to keep the rent from these social. And we're going to be able to set rents in our properties at levels that key workers can afford. So we, as a government, will actually deliver. Now, some people have accused me of communism for suggesting this. But what I'm saying is actually this is the best way to get the government to stimulate the private sector to be more efficient.
Yeah.
So and this would actually be good, because at the moment, I mean, what's the tax?
They become a competitor, really, and competition does create
and
organic
prices. The government says we're going to look after those hardworking professionals who are doing public sector jobs that are critical to society. And what we're going to do is make sure that they've got affordable places to live. They're going to make sure they've got good quality, affordable homes where they need them. That's the point of doing that.
Yeah.
That also will reduce the taxpayer's bill for temporary accommodation, because what a stupid waste of money that is. I mean, I get why they have to do it, right? But what was it, Kent Council saying, one of the councils last week saying 50% of their entire budget is going on temporary accommodation, which is like setting fire to money. You imagine how many homes they could build with that money instead. And from an investment standpoint, what do you want to do? Pour money down that black hole of temporary accommodation, or pour that money into creating jobs, constructing homes, and building government-owned assets that are there to protect the kind of people who want to have a really fulfilling career but aren't chasing money, right? Nurses, policemen, doctors, those kind of people who are not just chasing money alone, but actually want to have a career where they're helping people. Let those guys have an affordable place to live, because actually everyone needs those people. Society needs those people to have a good place to live.
Yeah.
So if the government was to take the amount of money it's spending on temporary accommodation and go, do you know what? We're going to build houses now because this is a waste. This is a stupid waste of money. We've got 250,000 people currently living in temporary accommodation at the taxpayer's expense. That just doesn't make any sense on any level.
And not only that, that's probably contributing towards the bubble in rent prices.
Exactly that. So what I'm suggesting would actually, I think, boost the economy. It would boost wages. It would therefore boost house prices. Stop house. This would be the best way to stop house prices falling, in my opinion.
Under Tory government, that's not happening. But considering Labour's going to be in power soon, what you're speaking of could be probable. It could happen because they know that building is needed. And they have been signalling, look, we intend to embark upon building a lot more homes. And if they're going to use government capital to do that, then I think something along the lines of what you're saying probably might come in within the next 2-3 years, because Labour are going to get into power and they are going to want to have a second term. So they are going to want to produce in certain areas. And I think healthcare, housing will be two of the areas that they will produce. Interest rates, do you think that they're going to be coming down this year?
Sorry, do I think what's coming down this year?
Interest rates, because you've got
Right.
quantitative tightening, obviously the money supply is falling, inflation, that's obviously falling. What do you think about interest rates? Because the Bank of England is signalling a bit that cuts can be on the horizon.
I don't think that's what they're signaling. I think they dangle that carrot just to keep people hoping. And
Yeah.
there's one person out of 9 that voted for a cut today, only 1 out of 9, and so my confidence level in where interest rates are going is low. It's very, very low. I don't have a confident outlook because there's too many variables outside the UK government's control, too many international unknowns happening, and we've got 50% of the world's democracies having elections this year. All kinds of stuff could happen that's utterly impossible to predict. So right now, anything could happen. Any of the three, they could go down, they could stay the same, they could even go back up. Right now, I think the least unlikely, so therefore the most likely, if I was a gambling man, you said, Charlie, you got to put all your money down, whether going up, down, or sideways. I would say sideways. But that's with low confidence. I'm saying that I do not. I get why everyone's hoping for lower rates, because it's destroying businesses, it's destroying livelihoods, it's destroying people's chances.
Yeah. Certain media has been giving off that the BOV has been signalling that. GB News, City AM.
Yep.
So, do you reckon that the estate agents will take that as a bullish indicator and will do what you said earlier? Will use it as a sign of, right?
Always.
Do you reckon they're going to do that?
Yeah, they just
even if it's just 1 in 9 votes for it.
Yeah, exactly. And that's already happened. I mean, the Bloomberg headline today was "Bank opens door to future rate cuts." No, what? No, they didn't. I mean, that's just ridiculous.
As us traders always say to each other, never believe the street. And obviously the street is trying to give off that bullish sentiment. Bloomberg, City AM, even to political mainstream media like GB News. But no, I'm with you. I don't think that we're going to be seeing them soon.
If I was still an options trader, I would be buying volatility.
Really? Oh, you're talking to someone who's been shorting VIX for the past 5 years. Oh, the old Crush Fix Friday trade, that's done me very, very good. But you are right. Short VIX trade, I've not embarked upon in the past few months because VIX has been falling a lot. So the risk has been increasing and the reward has stayed the same, because VIX does get crushed a lot. It does. On Friday, it gets crushed literally every Friday. Not only that, it's created a band, of traders which have now turned into a mini sort of cult going back for the past 10 years. It's just all jumped on the ball and just every time Friday comes, or even retail traders, investors have been doing it every Friday across investment communities, Wall Street Bets, the websites, the brokerage communities. It's like, are we all crushing VIX today? Are we all shorting VIX? But in the past few months, a lot of the short VIX crew have been sort of moving back, like, hold on a minute here. The reward stayed the same, but the risk has increased a lot. You've got geopolitical risk, you've got certain other types of market risk, and yeah, you are right. And I have been saying to a few people, buying into VIX funds, getting exposure to the VIX without buying the options or the futures is a hedge for this year. So it is a hedge for this year. That's what, in my opinion. So I am of the same thought of you. VIX, I think, is going to blow up. I think Colbatt knows it. I think it was Colbatt that said there's a chance we've got VIX hitting when the next blowout occurs. VIX could break 100. So you have got some respected like hedges or Wall Street investors that have sort of come up and said this could break out so much, it could break the 100 barrier.
Nice.
Yeah, but I
I
do
don't know.
think rates
I,
cuts aren't coming this year.
so I don't know if you know this. I used to be a futures and options broker.
I didn't.
So back, it was my first job. It was my first career. I had jobs before that. It was my first actual career move. So I was registered. I was a registered representative of the Securities and Futures Authority, and I worked on the Open Outcry Life Exchange.
Yeah.
And I'll tell you what, being in that room full of 2,000 people wearing wacky colored jackets, screaming and shouting and waving hand signals and all that kind of stuff, I learnt what a market is and how a market works.
And how human psychology works.
You know what? And I saw all the different kinds. I saw the market makers. I saw the independent traders, the jobbers, the day traders. But it was all in physical, in real life,
Yeah.
and seeing it was just incredible. And it really made me understand all of the factors and dynamics that affect markets.
Is that why you're a bit of a contrarian now? Would you say? I reckon,
Yeah, of course
yeah.
it is, because that allows me, unusually in the property market, it allows me to bring that training. So I was broking all the derivatives, not just financials, but also commodities, soft commodities, forex, the whole lot. And so I got this incredible sort of wide-ranging training of how financial products and derivatives all work. And I had my best mates working at Bear Stearns, and the company I worked for was the largest broker on the live floor. So we had all the banks as clients. And I traded my own book a little bit, and I was always trading on volatility. So I used to my favorite one was short sterling. So short sterling futures was what I used to trade. I used to do a spread between the different months. That's when I was 19 when I was doing that job. And
so you look at the property market from a sort of market stroke monetary and capital point of view, whereas a lot of people in the market, they're only looking at it through the lens of the property market itself, when essentially it's the financial capital markets which underpin the property market.
Yeah, and there are three big things that everyone gets wrong about the property market. And the first and most important one is the timescales of it, how slowly it works. Unlike any other market, which you can get in and out of almost on a daily basis, the time, and as you know, I don't know if you know this, but options values have one of the elements of an option price is its time value.
Yeah.
So the time value involved in property transactions is massive, and the risk and the volatility, if you were pricing it in the same way, would be really high. And it's not about property prices; it's actually about what I think of it as opportunity prices, because two different sellers of an identical property have got different reasons for selling, different time horizons for selling, and will therefore sell at different prices. Does that make the properties different values?
Yeah.
So people get that wrong all about, and basically a property transaction from cradle to grave is a minimum of 12 months from when someone decides on average. And so now look at what can happen in markets, in society in a year. That's the first thing they get wrong. The second thing they get wrong is this whole supply and demand thing. It's not about buyers versus homes. It's about availability of money versus homes. It's nothing to do with how many people want a house. Everyone wants a house, and everyone wants a nicer house. So if you're measuring on that demand, and it's not about population levels either. It's much more complicated than that. But it is supply and demand is the supply of available property for sale. Obviously, that gets restricted, and that does have an input factor. But on the other side, demand should not be measured in number of buyers inquiring. It should be measured on the availability of credit.
Exactly. Because when a buyer demands to buy a property, maybe they'll to factor in they demand a mortgage, because
and the mortgage terms as well, because it's so much more complicated than just supply and demand, because it's the term of that mortgage, it's the rate of that mortgage, it's how much is being offered. All of these things change house prices. None of them, very few of them, have to do with how many buyers. How many buyers is a really crude and not accurate measure of the property market.
No.
What is a better metric? And
it's just like trading volume. It is.
Yeah, exactly that. So something that nobody reports on, I hope to report on through Best Agent, is offer volume. Offer volume. So how many offers are being made on a property within the first 28 days? You track a metric like that, you've got a much better knowledge of what's happening in the market, because that will go up and down from one month to the next in a way that really indicates what's going on in that market.
Yeah, it's the turnover as well. When looking at stock, a lot of companies, especially from an investor relations point of view, will look at the turnover. So the shareholder turnover, they'll prioritize that over the trading volume, because there will be stocks that might top 90%, but their trading volume's only down 10, 20, 30%. And sometimes when stocks fall, they then become very illiquid. So one boosting trading, so one, let's say the trading volume increased 500% that day, it will create a move that will be very small relative to that move, that trading volume spiking 500% in one day, 2, 3, 4 years prior, when the stock was trading at a much, much higher price. So trading volume isn't really, not really on real time. Looking at it from trading in a real time point of view, yeah, it does matter, because it does matter in very, very sort of, but when you're looking at the long term and even the midterm, it doesn't really matter. So I do get what you mean when you do put it like that. So these two,
there's one more really important.
I've spoken to agents, who look at me as if they do not have a clue what I'm saying when I'm talking about quantitative easing and other things like that.
Some of them don't know what it is.
But it drives their business model.
No, but the skill that's actually required, and what I see amongst, I say one of the best agents I ever worked with. He was in Lavender Hill in London, and he had 3 branches. He's one of the nicest blokes I ever knew. He had 3 shops. He had about 12 or 15 staff, and he did really, really well. I met him because he became a client of the software that I designed and was selling to agents back at the time in the early 2000s. And he said to me, I sat there pitching in my software and talking about metrics, this, that, and the other. And he said, Charlie, let me stop you. He said, I'm going to go ahead and buy your software because I like you and you know what you're talking about. He said, I don't know what you're talking about. He said, I've got no clue about numbers. I've got no clue about accounts. I've got no clue about marketing. I've got no clue about technology. He said, what I know how to do is I know my patch. I look after my customers and I take care of my team. That's why I'm successful. And this is the point that no one understands about being an estate agent. It's nothing to do with selling property. It is nothing to do with selling property. It's to do with matching people, one person's situation in life with another person's situation in life, and working out which ones are going to work and which ones aren't. Because again, unlike any other marketplace, right? If you're going to buy any other marketplace, what you're buying, no matter who you buy it from, it's the same thing. You buy a bar of gold from Jim or John, it's a bar of gold, right?
Yeah.
You go and buy any commodity or anything else, any asset class, you're buying an identical thing. Every single individual home is different. They smell different. They look different. They've got a different view. They've got a different side of the street. And that affects the buyer's view. So the market is an individual going, which house do I like? Which one's furthest away from my ex? Which one's closest to my kids? Which one's, and all of these emotive, they have nothing to do with money. It's to do with the emotive reasons for the purchase. People sell because they're divorcing. People sell because they've lost their job and they've got to relocate for a job. These aren't.
So many variables.
And basically what it comes down to is emotion. And what no one understands about estate agents is that actually the very best estate agents are the ones who are best at dealing with people and helping people through what's a very, very stressful time. And you don't need to know anything about markets as an estate agent. You need to know how to get the seller to come off their high fence, and you need to know how to get the buyer to feel really committed to the deal, because otherwise you'll work for 5 months and they'll pull out and you won't earn anything. So this is why a lot of agents don't know what QE is. They don't need to. They don't understand. All they need to know is which buyers have I got and which sellers have I got and which ones can I put together, because that process has nothing to do with market forces.
And the main one in that the transaction is the mortgage broker. The main, when you've got a buyer, when you've got a seller, but you've also got obviously the mortgage broker issuer. I think the main one in them is the mortgage issuer, the mortgage broker, because without the mortgage broker, there's no buyer. Without no buyer, there's no seller chart. You get what I'm saying when I see that? So from a buyer and a sellers, yes, you've got the obviously the natural trade. I take, you give, blah, blah, blah. But then you've got, because it's relying on credit, you've got a third transactional party. which is mortgage.
No, I get
And
that.
without that, I think so. Whereas you look at the three, you're looking at the mortgage side, the buyer, and the seller side. Whereas most people in the industry, most companies in the industry won't really factor in the mortgage side, will factor in the buyer and the seller. But whenever there is a downturn that hits, when 2008 hits, a lot of agents and a lot of mortgage brokers themselves, they started to conclude, look, credit is a key driver to our business, and our business is in a toilet whilst we're in a credit crunch.
Yeah.
But now they're not looking at it like that. They're not. But surely there's got to be some, I don't know, industry capitulation at some point. You're saying Rightmove is being realistic with what they're saying, where basically sellers need to get to grip and start to reduce pricing. Do you think that that will start to hit a lot more companies, a lot more maybe media, property media companies? Will they start to take that sentiment and belief on and start to tell the sellers in the industry? Because the quicker they tell the sellers, the quicker the prices will reduce. The quicker prices will reduce, Charles, the quicker there'll be a recovery. And then that's when their business goes all right. So maybe they might think, do we want to come a few years of stagnation? Or shall we get this over and done with, reduce prices and let the market recover and we're back into business in a year rather than 3 years' time?
You see, the problem is that for that to happen, you've got to say to an individual seller, look, mate, sorry, you've got to take the hit so that we can all get on with our market.
That's where you need a mainstream media approach. Yeah. You do.
But you see, and I mean, even yesterday, Nationwide, no one reported on it, right? But Nationwide, I'm just trying to look for the actual quote. Oh, here it is. Nationwide's quote yesterday was, while a rapid rebound in activity or house prices in 2024 appears unlikely, right, that's a pretty bearish statement from a lender. The outlook is looking...
They're highly exposed to mortgages, mate.
The outlook is looking a little more positive. So that actually, in my mind, is a pretty realistic statement. While a rapid rebound in activity or prices appears unlikely, the outlook is a little more positive. You know,
it's and kind of play both sides, isn't it?
You had agents going, yay, Nationwide says everything's great again, which is not what they said at all. And so, you know, I mean, Rightmove doesn't help the problem because Rightmove's house price index is an index of asking prices, not an index that's got anything to do with the actual market price. It's like, you know, I go back to my open outcry market pit, right? Every single pit in that life exchange, there are about 15 different pits trading all the different European currencies and the government bonds, that kind of stuff. Each one had up on the screen the bid and the offer, right? That is a market, a bid and an offer. Yeah. That's it. And what sellers are doing in the context, it's like they're standing on the edge of the pit saying, well, my offer price is 10% above the current offer price. Well, you're not in the market, then are you? And that's the problem. And agents think that it's okay to list sellers' houses like that, and it just doesn't help.
Yeah. It surprised me when you're saying that Nationwide come up with that. And I'll tell you why, because Nationwide isn't really one of the UK big banks. But it's heavily exposed to mortgages when you look at its size compared to the mortgage. It's sharing its market share of mortgages. So they own their market share of the mortgage is roughly 11%. Whereas HSBC is only 8%, Barclays is only 10%, and they are two mammoth banks, far bigger than Nationwide. Santander, they've got the rough same type of market share in mortgages than Nationwide. So when you're looking at size, balance sheet, and assets, Nationwide, the balance sheets and assets of UK building societies and banks compared to their market share in the mortgage market, the market share of the mortgage market, Nationwide is one of the most exposed banks. It's the biggest market share is with Lloyds Bank. That's 18%. I think it's 17%. But Lloyds Bank is a lot more bigger than Nationwide. So if you were to look at Nationwide's exposure to the mortgage market, they are more exposed than all other banks and building societies. So it surprises me, you telling me that they're being a bit more realistic, because they're heavily exposed, and it's not within their interest, to be honest, about what's coming. If you're saying, look, they're being honest, but saying there could be light at the end of the tunnel, it's not really a bullish sentiment, is it?
It isn't, but they need to sell mortgages now. They need to sell more mortgages now, and so
Yeah.
I think what they're doing in my mind is correct, which is they're saying be realistic, and trading will happen.
Mm.
So all the lenders,
But they might have to take a hit in the mortgage book, though. They might, because if there is a price reduction, the more prices fall, the more it's going to hurt these banks and building societies.
yeah,
Even if they do increase their mortgage activity, because they're holding mortgages, they're holding MBS. So a reduction in the value of those assets, and those assets which are all part of bonds and securities, it's all intertwined. As we go back to 2008, mortgage-backed securities in the UK are MBS, residential mortgage-backed securities. Then there will be a securities element to it. There will be an element where the securities market isn't really going to be willing to basically buy nationwide mortgages that they take on. So, but I think so see, the nationwide is in a very precarious situation. It is in a very precarious situation, because you're right, it does want more mortgage volume and activity. So falling prices will create an increase in volume and activity, but the more the prices fall, the more it's going to hurt their mortgage. The more it's going to build more risk up in their mortgage portfolio. So they have to do one thing, but if they do it too much, it's going to hurt them. So,
lending criteria is getting tighter, and this is the factor, right? For the exact reason you describe, they're going to have to be tightening their lending criteria. Fewer large loan to value mortgages, because they don't want to increase their exposure. I honestly, I worry. I hope I'm wrong. Because my number one reason for thinking house prices are going to end up having fallen 35% by the time this is over from the 2022 summer peak is because what's about to happen to the jobs market, what's actually begun happening to the jobs market already, but there's much worse to come, sadly. And if I could see any source of real sustainable growth anywhere, I wouldn't feel so bearish. I'm an optimist by nature, I really am. But I've learned, life's taught me to be a realist. Being in the market's taught me to be a bit of a realist as well. And there's no point in making your future decisions based on hope. It always ends up badly. Hope for the best, sure, but prepare for the worst. And hopefully it'll be somewhere in the middle.
Yeah, mortgage defaults are up. They are. So the more prices fall, the more mortgage defaults are going to go up. The more mortgage defaults, the more that's going to put these banks under. Well, that's more exposed. They're going to make these banks more exposed. So what? Right, I know it's a bit of a hypothetical question, but let's say that rates stay at the current 5.25% throughout this year. When do you think house prices will recover? Because if they stay at 5.25%, there's a probability that house prices are going to keep on falling, because we've got a wave of layoffs, we've got confidence falling. So no matter what the sentiment may be from mainstream media or even the central bank, the coming wave of unemployment and layoffs is going to affect demand. And I'm quite adamant that prices are going to fall this year. If prices do fall throughout the year, and it's at the end of the year and prices are down, when do you think prices can recover at some point? Do you think that they will recover based on because usually when prices recover is when they get to a point where that asset becomes very valuable, like the stock market. It doesn't matter some companies balance sheets and financial accounts can look, well, like dog shit, put it that way. But if that company falls 98% in price, that company can become a valuable company. So dependent on the price of anything, well, anything sells at a price is dependent on what that price is and the value underlying that price. So, what do you think if we do carry on? If the house prices, if the housing market does fall in prices this year on a micro level and on a national level, when do you reckon there will be a recovery, or is that something you just can't put your
I have an opinion on this.
go on?
You're not going to like it.
Come on.
I don't think house prices are going to stop falling until well into 2025.
Really?
I don't think we will see. Yeah, they'll just keep on sliding. They're not cracked. They're going to keep on sliding for another couple of years because, and this goes back to the point I made about how slow the property transaction process is and how slow price reporting is and how long it takes today's activity in the market to feed through to completed prices, which is about a year.
I've got
So
you.
because
Yeah.
prices will keep falling this year, which means people will be transacting this time next year. And we won't see the results of that until the year after. So I don't think we will see the bottom reported until early 2026.
He's bearish.
And I think it's going to be flat until 2030. Alex thinks that different reasons well, I mean, we kind of have overlapping reasons, but not all the same reasons. And even Richard Donald from Zoopla agrees that once prices have fallen, he doesn't agree how far they're going to fall as I do, but where all three of us, Alex, Richard Donald, and myself, agree is that wherever they bottom out, they ain't coming back up for the foreseeable future. They're just.
There's only one thing. There's only one thing, and no doubt it's gonna happen. No doubt it'll have to be a big event to make it happen. But quantitative easing. If they embark upon quantitative easing because of one event, geopolitical or a market event itself, then they are backstopping the downfall in property prices. That is, I'll state that now. If we do have a decline in property prices and they do carry on, and somehow they embark upon QE again, they will be backstopping the basically backstopping the property market.
That won't solve the
will the delay be a bit too, because you mentioned a delay?
Yeah.
So
2 year delay. I think, I mean, it's been, how long has it been since they started raising interest rates? And today the Bank of England said they still reckon there's another 30% to go until the full effect of their rises actually feeds through to the whole market.
Did you say a 2-year delay?
I think it's a 2-year delay from when they
announced. Have they done QE? Yeah, so if they announced QE now, we're looking at 2026. I've got I'm starting to see the logic behind why you're putting that
and
year.
I think that a lot of investors and traders just don't understand that every other market you can trade, get in and out on a daily basis. You cannot do that in property.
No, it's not real time. It's not.
Yeah.
Settlements, all of it, it's not real time. So I get what you mean. All right, well, I'll take that on. I see a lot of logic behind that, where you're saying, look, Mike, if they've done QE today, the 2-year delay will basically still will put it towards 2026. So if there is QE today, then we probably won't see the recovery in prices till 2026 because of the 2-year delay. I've got that logic. When you say that to agents, say something like that to estate agents, look, it's a 2-year delay, which is a problem. How do they react to that? Because I'm assuming a lot of them sort of automatically hate you.
They just sort of, they do. They hate
the truth hurts. Yeah.
I've always said to agents, house prices don't affect you. As long as people want to move and as long as you're there to help them move, you make your fee off the transaction, whatever the house prices are. House prices only matter to agents if you are relying on this always up narrative. And so if you have pinned your whole business to house prices always go up when they're going down, you're fucked.
Yeah.
So what a really good agent will say is, whatever the market's doing, I will get you moved. That is an agent's job. Whatever the market's doing, I will get you moved. That's where they add the value. But to answer your question, what do they say when I say things like there's a 2-year delay if they bring in any stimulus? They just sort of glaze over. They don't really respond. They just sort of don't want to hear it. And I mean, I've seen this. It happens with my kids. I say something to my kids they don't want to hear, and they just sort of look away and think about something else because they don't want to absorb the truth of what I'm saying. And I think this is, with the people who don't believe me on the 35% house price falls, why am I that bearish? It is a long. It's not a list of things that add up. It's a list of things that negatively multiply.
Yeah. I
downward
think at
effect.
the end of this year, you will be coming out with examples of very, very high end prices that have fallen 30 to 40% going back the past couple of years. There is
Yeah,
steep discounts in
yeah,
luxury
yeah,
property. So I think at the end of the year, there's going to be many, many examples of 30 to 40% discounts on
yeah.
luxury properties between £1 million and £5 million, especially in cities, inner cities
And the other
like
thing,
Manchester, London.
sorry to interrupt you, but yeah, the
Tell
other
me.
thing that being in those markets taught me is that when liquidity drops, price volatility increases,
Yes,
and therefore in a trending downward market with less liquidity, which we have right now, it will accelerate price falls, but we won't see that for a year
it's
because
that
that's
same
how long it
mechanism for the
takes.
stock market, but it's real time.
Yeah,
It is because obviously you got real time settlement,
yeah,
so or 1 to 2 day settlement. So
yeah,
yeah, I see. So it's a 2 year delay really is the main key. So it's like if we do QE today, or if they cut interest rates today, it's still the delay factor because as we're seeing, it's been roughly a couple of years since rates started to rise,
yeah.
and it's been kicking in a lot recently, and it started to kick in last year with luxury properties. And my dad's girlfriend, she got a 13% cut discount on the house in Kent. She moved from London to out of Kent.
Oh,
She did so, but she didn't take. She only took, I think it was a few percent discount on the London house. So, which is why I probably partly contributed towards my theory in that counties that have a lot of middle class and upper class people living in them are going to have a big hit in terms of property
yeah,
pricing. I think Surrey, especially around the stockbroker belt, is going to get hit a lot. But yeah, no, I do. I really, really do like that. You do give that contrarian approach, but at the same time, you're saying, "Look, I've got skin in this game. This is my business." And to be
yeah,
honest, I'm quite optimistic at the same time. But the more realistic we are, the more optimistic you will eventually be, because realism always leads to a reduction of price, and a reduction of price always leads to a recovery stroke a rally. The three R's, they always come in, and no, you know what? Not even the banks, not even the controllers of credit can control that.
yeah,
Can control a market like that because you've got variables, you've got different fundamentals, you've got psychology, because they could. It don't matter if they control the credit, then you've got the demand factor that comes in. So there's so many different variables and fundamentals to factor in, and you're doing it from not just the property market. You're factoring in the monetary side and the financial and capital market side. And I think throughout this year, a lot of people within the property market are going to start putting their eyes towards what's happening in terms of monetary policy, because they're going to start to conclude, look, it's the supply of credit, it's interest rates, which is basically underpinning our business. So maybe we need to be honest and tell those who are selling, the sellers in this market, look, you've got to start getting a bit realistic with your
yeah,
approach. And that's what happens with the stock market, because if just a few percent of the stock market become realist, then the market will take that on and think, well, why is that the case? And then that will create a domino effect, which is why you always see the stock market is pricing things in advance. So a stock market tends to be a snapshot of what's happening within the next 6 to 12 months. And what we've seen with property stocks going back the past 2 years seems like what we're going to see with your theory in price is going to fall 35%. Right, before I go, I'd like to finish off and get your predictions on a couple of things outside of the market, Char.
okay.
Right, who's going to win the general election this year, UK one?
Oh, well, at the moment, if they held it tomorrow, Keir Starmer would get it, no problem. But I suspect between now and whenever they have the election, there's going to be some ructions, some major ructions. I don't know what they're going to be. I just think that if just keep your eyes very closely on Farage and Reform and
Yeah.
Tice and the Tories wanting to replace Sunak. My gut feel tells me that there's a lot more to happen in this story before we get to election day, and the choice we've got today may not be the choice we have then. And so, yeah, if it was today,
Because their immigration ticket isn't working no more.
no,
The more
no,
tougher on immigration they're getting, the more voters they're losing.
it's I just think their credibility is shot to pieces, and so it's whether or not whether or not they replace Sunak, possibly, whether or not other parties get, I don't know, this, I just sense some frantic stuff happening behind the scenes of people trying to organize stuff into some kind of new challenge. If we go into election Sunak versus Starmer, then Starmer's going to win,
Yeah.
which I just think it's going to be more of the same. I don't see any big changes happening.
Likewise. Public sectors might get maybe an extra 1% increase in their pay rise, other than what Tories would give them.
But otherwise,
I think there will be a programme with healthcare and housing. Like I said that to you earlier, didn't I? I do think there will be programmes there because they're going to want to keep. They're going to want a second term. Power is going to want to. He's going to drive them. Well, Power is going to drive them to want to have a second term. And I think housing and healthcare are going to get them their second term. They're not going to do it with immigration or social issues or cultural issues. So I do think that if they are going to produce in one area or a couple of areas, I think housing and healthcare will be the two areas. And we could see what you said earlier about social housing program. If Trump becomes a candidate for the Republican Party, who do you think is going to win out of Trump? And if Biden doesn't stand down, I think Biden's going to stand down in March, by the way. Let's say that it's Biden versus Trump. Who would you put your money on winning?
Trump, easily this time.
Definitely. 100%. It's going to work.
The world's changed a lot since the last one. But I think there's talk about it being Michelle Obama instead of Biden.
I think it's going to be Mark Cuban.
Yeah, okay.
Yeah. I'm going to think.
My gut feel is that a lot's changed. I actually think Trump himself has changed as well. He's much more conciliatory in his approach this time. He's not been quite so firebrand. He's being much more moderate. Bizarrely, never thought I'd hear myself say that about him, but he's being more moderate and
running a bit on a unity ticket, isn't he? So we need to unify Democrats and Republicans.
Yeah.
He knows what he's doing.
He's a clever boy. He's a clever boy. Whatever else you think of him, there's a lot of things about him which are I think do worry people. But who knows? Yeah, that's that. So I think we're at the moment today. The money would be Starmer and Trump by the end of the year. But as a caveat, I think there's quite a few things could change between now and the end of the year before the elections happen.
Yeah.
Thank you, Mike.
Well, Char, it's been an immense pleasure to have you on my show, pal. And I know many people do respect your opinion. I do. And I know my listeners and clients are going to be very, very interested to hear the show, pal. And I'd like to get you on at some point in the future, 3, 4, 5, 6 months' time. Would that be possible, mate?
Absolutely. It's been my pleasure. I'm honoured to have been invited, and I'd be very, very happy to come back and talk to you again.
Thank you for giving us the time, pal. And until next time, Char, have a prosperous and a productive time, mate. Yeah?
You too, mate. You too. Thanks.
Be lucky, Char. Ta-la.